Financial crisis and drop in commodity prices in 2015, the World Bank says economic growth was set to slow in Sub-Saharan Africa to 3.7% this year. That's from 4.6% in 2014. Even then, African nations made tremendous progress reducing poverty on the continent.
2015 proved to be a tough year for Africa's economy, faced with a slowdown in export markets and a slump in commodity prices, particularly oil. This put robust economic growth rates in jeopardy.
Many countries are borrowing simply too much relative to the size of their economies. But secondly, governments are also borrowing in US dollars. In the last year, many African currencies have depreciated very sharply against the dollar, and that means the value of that debt in local currencies has grown. We've calculated it's grown by over $10 billion in the last year.
In Africa's biggest economy, Nigeria, the effects of the global oil price slump saw its economic growth drop to more than 5%, down from an estimated 6.23% for 2014. Its oil industry accounts for around 95% of the country's foreign exchange earnings. Along with the oil price slump and a postponement to the Nigeria elections, its currency, the naira, slid to a record low, stirring concerns about political stability and the central bank's ability to manage a currency hammered by weak oil prices. The central bank devalued the currency by 8% at the end of November.
Slump in the oil price, in my opinion, yes, it will hit us in terms of revenues, because we know 70-80% of government revenue is based on crude. But also, we also look at the other side. The drop in price means that we also import refined PMS. So, of course, the price that the money we have to spend on subsidies to get these refined products in also goes down because the price in the international market has gone up.
Nigeria's economic troubles also trickled down to some of the country's biggest firms. Nestle saw its capital expenditure slow to its lowest level in 5 years. A raging militant insurgency in the north had also limited the company's product distribution plans.
I think overall the consumer sentiment is definitely much lower. So confidence in the market is lower. So if you look at our customers' confidence, it's certainly being impacted by the challenges that we face in Nigeria. The challenges are many. And yes, it's all about the oil price, and yes, it's about the currency, it's about the uncertainty of the economic climate now.
In nearby Ghana, once hailed the most attractive country in Africa for investors because of its stable democracy and middle-income status, a struggling economy saw recurring nationwide protests against what Ghanaians say was the government's mishandling of the economy. Ghana's government and the International Monetary Fund signed a 3-year funding deal worth $940 million that led to hopes of restoring fiscal stability.
The original source of our problems has been lack of discipline in economic management. In other words, that hyper expenditures, extra budgetary expenditures, all those things, single sourcing without going through the procurement law and all that has brought us to this stage. What the IMF intervention is doing basically is to help to instill discipline in the management of the finances of this economy so that things can be stabilized for private enterprise to boom and pick up.
But it was not all gloom for the continent. In June, representatives from 25 African nations signed an initial agreement to create a free trade zone linking 3 economic blocs that would unite 57% of the continent's population. The deal also intends to reduce trade barriers that will bring down prices and boost economic activity between African countries. Although analysts say the agreement looks like a progressive step on paper, they are skeptical of its success.
The challenges are that it is a very bureaucratic system. These countries, some of them are Arabic speaking, some of them are English speaking, some of them are French speaking. They cut across, the infrastructure doesn't support or facilitate this because you cannot drive a car or enter a train from Cairo to Cape Town, right? So it's a very, very elegant concept. But it's going to take a long time to accomplish, and not to talk about when you see the benefits. The benefits take much longer to accrue to the participating countries.
In Southern Africa, Zimbabwe's crumbling economy was dealt a new blow when the IMF announced that the government economy would weaken further after growing by 3.1%. The government had forecast growth of 3.2%. But analysts said weak commodity prices, patchy rainfall and company closures and high interest rates could curtail the economy's growth.
The economic outlook, we have to say, remains difficult. The external position is precarious and the country is in debt distress. Growth has slowed down, it's likely to weaken further.
Zimbabwe's foreign debt is $9 billion. It makes token monthly repayments of $150,000. To make matters worse, the Reserve Bank of Zimbabwe announced in June the process of demonetizing the Zimbabwean dollar. It started collecting old currency notes from the public. In East Africa, one of the continent's biggest airlines faced uncertainty when Kenya Airways announced plans to sell off part of its old fleet and some land. This saw the national carrier through a cash crisis caused by a drop in passenger numbers, but its CEO remains optimistic about the future.
Today we are focused on making sure that that we are commercially and financially efficient, and that's why we are focusing on the commercial side of the business to make sure we are taking all the opportunity we can, even in a difficult commercial space with security concerns around us.
But for Kenya's biggest telecoms operator, Safaricom, business went from strength to strength. It announced a push to expand its mobile financial services and internet access as the next big areas of growth.
Customers' needs are changing rapidly. Customers' behavior is changing rapidly. At the beginning of last year, if you'd asked me when exactly would we roll out 4G and how quickly would we do it, I wouldn't have been able to say to you that by the end of the financial year, which was end of March, we would have rolled out 230-something LTE base stations.
In neighboring Ethiopia, Heineken looked up to the country's rising incomes to fuel rapid expansion of the beer market in Africa's second most populous country. Ethiopia's average annual beer consumption of some 5 liters per capita is about half the average level for Sub-Saharan Africa, excluding South Africa, offering scope for expansion among the population.
At the moment we are developing our position in the local market. Like I said, our first priority is to become a national player, fulfill our ambition to become a national player all over Ethiopia. That's our first priority. Export also has to do a lot with the supply chain. In order to be able to export, you have to have a supply chain adapted to the export markets.
This year, Somalis in the diaspora continue to face the challenges of sending money home. That's because a growing number of banks who provide the vital lifeline closed down links with the Horn of Africa nation. Virtually all major US banks have ended remittance services to Somalia over the last few years because of regulations that hold banks responsible if they transfer funds to terrorist groups like Somalia's Al-Shabaab. Some 40% of Somalis rely on remittances for daily needs such as food, medicines and school fees.
We are requesting American authorities not to shut down the transfer of money and instead create a system where they can control the flow of this money.
To the African Development Bank, African economies will grow 5% in 2016, approaching levels last seen before the 2008 global financial crisis. Sfisos Kosana, SABC News.